Morning folks, welcome to Jackson's TV. It's the morning after the Chancellor George Osborne's emergency budget, so it is the 23rd of June. So the purpose of this video is to give you a summary of what was announced yesterday, so that you can see how it might affect you. If you've got any questions on that though, of course, please do ring us and we will do our very best to answer those questions. Now, I've got some notes here, so I can't do all this off the cuff. We think this was a necessary budget. Of course it was. The deficit is massive. What the Chancellor said is that they have aimed to use an 80-20 rule, that 80% of the savings will come from spending cuts and 20% will come from tax rises. Whether or not he's achieved that, I'm not able to run those kinds of numbers. We'll have to wait for perhaps the Institute for Fiscal Studies or somebody like that to come up with a proper study on those numbers. But that's what the Chancellor said. So these are the headlines. We'll go with taxes first. The big one, of course, was the increase in the rate of VAT as of the 4th of January next year, rising from the current rate of 17.5% to 20%. So make any big purchases before January next year. If you fancy a 3-piece suite or a new fridge freezer or something, do that now. As far as income tax is concerned, the personal allowance, which is the amount that anybody can earn before paying income tax, was increased from its current level of $6,475 up to $7,475 from April next year. That apparently will take 880,000 people out of paying tax altogether. So that's good news, generally speaking. As far as national insurance is concerned, which is obviously, of course, as well an income tax, the upper earnings levels were reduced and the employer national insurance threshold was increased. What the upper earnings level does is effectively means that anybody paying higher rate tax won't benefit really from that increase in the personal allowance. Part of the Chancellor's and the coalition government's bid to make sure that those who are less well off are not too badly affected, and that those who are more well off pay more of a share of the burden. So that's income tax and national insurance. Capital gains tax is increasing, but only for higher rate income tax payers. So if you're a basic rate taxpayer at the moment, your capital gains tax rate will stay at 18%. But if you are a higher rate taxpayer, it will go up to 28%, and that's as of midnight last night. Pleasingly, the allowance, the amount each year you can gain without paying capital gains tax, has stayed the same at $10,100. We did wonder whether there might be some changes there, or whether the new capital gains tax rate might be significantly higher than it actually went, so we're pleased about that. What we can expect to see though is some inter-spouse transfers, quite rightly so. So if you've got one spouse paying higher rate tax and one paying lower rate tax, you can benefit from the capital gains tax free transfer from one to the other before the asset is sold, so that the capital gains tax is at 18% rather than at 28%. Entrepreneurs relief, which is a special rate of capital gains tax for qualifying assets, has the amount you can gain in your lifetime has been increased from 1 million to 5 million, and the rate stays the same at 10%. For business owners, corporation tax is being reduced. The main rate is being reduced by 1% a year each of the next 4 years, so that it comes down from 28 down to 24%, which is the lowest rate in UK history apparently. For smaller companies like Jackson's, our corporation tax rate is being reduced by 1% to 20% as of next April. Last thing in taxes is that there's going to be a bank levy introduced, which will help plug the gap. A large part of the gap, of course, being created by bank bailouts. Now, how about pensions? Well, some good news for those in receipt of the state pension. It's now going to be subject to something called a triple lock. I'm sure if you are in receipt of the pension, you've laughed at the derisory 75p a week increases that you've been given, or 25p a week increases that you've been given recently. From now on, the increase in state pension is going to be linked to the higher of the rise in earnings, national rise in earnings, prices, inflation, or 2.5%, whichever is higher. Important to know that the prices bit, the inflation bit, is going to be the lower index, which is called CPI, Consumer Prices Index, rather than the higher Retail Prices Index. But good news is the state pension is going to go up by the higher of inflation, earnings, or 2.5%. So that's definitely a good thing. One piece of news which we're delighted about is the end to compulsory annuitisation at age 75. Currently, if you have a pension plan that you've been saving into and you get to age 75, you have to buy an annuity with it. I won't go into reasons why that might be a bad idea or a good idea, depends on the circumstances. But the fact is it was an imposition by the government on this arbitrary age of 75. Well, that is being swept away from next year, from next April. If you hit 75 between now and then, there are some transitionary measures in place so that you don't have to buy your annuity. The previous government was going to introduce some very, very complex rules on higher rate tax relief for pensions. Many of our clients are higher rate taxpayers, of course, and the tax relief you get on pension contributions was going to be unbelievably complex. The new government is now planning to consult on that, and hopefully, we're hopeful that the very complex changes are going to be swept away, probably to be paid for by a significantly reduced annual allowance, but we'll deal with that as that comes in. Okay, so that's taxes and pensions. As far as benefits are concerned now, child benefit has been frozen for 3 years. Tax credits generally are now only going to be available for those households with an income of under £40,000 a year. Important point is that pretty much all benefits are now going to be increased by CPI rather than RPI, Consumer Prices Index, rather than Retail Prices Index. CPI is lower, so if you are on benefits, your benefits are going to increase at a lower rate than they have been doing. The other big thing on benefits is that disability living allowance is now going to be subject to a medical test rather than what is apparently a very complex form at the moment. So that'll be good news perhaps, but not so good news if you don't want to sit a medical. Just a couple of miscellaneous things. The ISA contribution limit, which is at 10,100 at the moment, will become index linked from next year. If you're a public sector worker, your pay is going to be frozen for the next 2 years, unless you're earning less than £21,000, in which case you'll receive a flat £250 pay rise for each of the next 2 years. John Hutton is going to be reviewing public sector pensions, which is a massive drain on the the country's finances. I shouldn't say drain really, because that would imply that public sector employees don't deserve good pensions. That's not the case, but they are unsustainable, so something needs to be done. So there's going to be a review on public sector pensions as well, so watch out for that. And finally, council tax is going to be frozen for 1 year from April 2011. So what do we think about this budget? I've fired a whole load of facts at you there. The graphics have come up alongside me, obviously. We think it's a good budget for reducing the deficit. It's an essential budget. The Chancellor himself called it an unavoidable budget. As with anything like this, whether you think it's a good budget or not depends on your circumstances. If you're a cider drinker, it's a good budget because the proposed increase in duty is not going to happen. So we think it's a good budget overall. We think it was tough, strong, but fair for the most part. We're pleased, delighted even, that the Chancellor stayed away from complex proposals, particularly when it comes to taxation. The capital gains tax proposals he's made are simple, easy to understand and apply, and that makes them easy to work. So we're pleased about that. And we're actually pleased that the rate didn't increase further than it did. So I think there's a lot of good news there. And I think the last thing to say is make those big purchases before 4th of January 2011 when the VAT increase hits. Any questions, you know where we are, please call us. We'd be delighted to answer any questions as they relate to you. We'll obviously be digesting all this information and working out how it might affect our clients, and we'll be in touch if there are planning angles that we can use as a result of these measures. Thanks for watching. Please call or leave any comments on the website if you have any questions.